Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Starbucks fundamentals. I'm going to do a quick review of their past earnings for Q4 to help me determine if this is a company I want to proceed looking at. So today we're going to take a look at a lot of financial numbers, and we're also going to take a look at some metrics and compare it to some of its competitors. So let's get started. One thing, like always, I always have my buddies Bull Solo and Darth Bear here ready to keep track to see how the company is doing. But since this is a quick review, I might let them just stay back and relax and let them enjoy the show. So I'm going to use this great website known as lazyfa.com, which allows me to see all these financial numbers in an easy visual format for past quarters. This is information pulled out from the 10Q reports and the 10K report. All right, so first we're gonna take a look at some metrics comparing Starbucks with some of its competitors. And the competitors I chose today are McDonald's and Yum. And by doing this, it also helps me see if any of those other companies are worth taking a look at. So the first thing we're going to take a look at is PE ratio, price to earnings ratio. And here I'm looking at quarterly data. So right now we can see we have about 6 years of five to 6 years of data right now. And one thing to see is all of these move pretty much the same way, right? All the food sector, restaurants, McDonald's, Yum, and Starbucks all move within the same pattern, the same wave. And we can see in the early days, Starbucks was much higher than McDonald's and Yum. And things have actually changed in the most recent years where now Starbucks is actually sitting on par with McDonald's and Yum. But we can see Starbucks is still pretty high. A little on average, it's higher than the others. This quarter, Starbucks was sitting at about 29.9 PE ratio when it did its earnings. McDonald's was sitting at 30.65. So these are PE ratios based on when they gave their 10Q report. So these don't reflect the current ratios right now based on the stock price today. But it helps us give a form of average or range within how the company moves. And we can see, right, on average, it seems that all these companies stay within the 20 to 30 PE ratio. And that's what we're seeing right now. Right now, we're seeing Starbucks at 29.9, we're seeing Yum at 30, and we're seeing McDonald's at 27.8. So one thing to see here is, one, Starbucks follows trends with all these companies. Two, Starbucks is within range of all these companies and is staying pretty intact. So that to me is telling me that Starbucks is not overvalued, but it's not undervalued when we compare it to its competitors. Starbucks itself, all these companies can still be overvalued, but when we compare them against each other, there's no one being more overvalued or undervalued than the other. But let's just take a look at Starbucks PE ratio at the moment based on yesterday's close of stock price. So the current PE ratio is 28.53. 28.53 will fit within this range that is normally in between 20 and 30. So if this company, in my opinion, if this company ever has a PE ratio of in the low 20s, that would be a great time to definitely jump into the stock based on these ratios alone. Obviously, you shouldn't base anything on this ratio, but that to me would tell me this company is sitting at cheap compared to how it normally is. Next, we're going to take a look at price to sales ratio. So price to sales ratio is one I definitely like to see, because price to sell ratio is total market cap of the company. So whatever the whole company is valued divided by the total revenue. All right, so here, another thing we see here, Starbucks from the beginning always used to be the highest of all. It used to have the highest price to sales ratio, especially when we compare it to McDonald's and Yum. But look how things have changed. Throughout the past quarter since 2013, Starbucks has maintained its range of between 2 to 4 price to sale ratio, right? Right now it's sitting at 4.07, and it doesn't seem like it fluctuates that much. But let's take a look at McDonald's and Yum. McDonald's and Yum seem to be at an uptrend, and they are much higher than Starbucks. So that to me tells me that Starbucks, when we're looking at its total sales, it is undervalued compared to its competitors, and that's one good thing. Especially if we see growth in this company And I already want to take a look more into this company based on this price to sales ratio right here. The next ratio we're going to take a look at is current ratio. So current ratio is just your company's current assets divided by its current liabilities. Here you want to have a ratio greater than 1. A ratio greater than 1 means that this company has plenty of assets to cover off any of its short-term liabilities. Again, first thing we can see is for a huge time, early in the beginning, Starbucks used to be so the first thing is, again, they all travel within a certain range as well. It does seem that Starbucks had a better current ratio in the past, but now it does seem like they're all pretty much intact. Right now, the current ratio for Starbucks is sitting at 0.9. Like I mentioned, this is a ratio I want to see over 1, and having 0.9, it means that this company has more current liabilities than it has current assets. But that doesn't mean that this company cannot pay off its current liabilities. I'm pretty sure this company has a positive cash flow from operations that helps it pay off its current liabilities. The only thing is I would definitely like to see a more of current assets than current liabilities. So it's not too bad, but it's not the greatest thing ever. Right now, the one with the best current ratio is actually Yum. So Yum is actually, it has a good current ratio. It has a decent price to sales ratio, and it's pretty much pretty close to the range of PE ratio. So Yum is actually doesn't seem to be over or undervalued either. All these companies seem to be okay. The only thing I really like is that the price to sales ratio of Starbucks is pretty low. All right. So next, finally, for the last comparisons between the competitors is going to be the company's total debt and the company's shareholder equity. So shareholder equity is total assets minus total liabilities. And we can see all these companies have a negative shareholder equity. And again, even though they all have a negative shareholder equity, it does prove something. It does give, right? If I was just to look at Starbucks by itself, I'd be like, oh man, this company has a negative shareholder equity. This is not good. But when we're comparing it to its competitors, we see that this is the norm for this sector. So it helps you. This is one good thing about looking at competitors. It helps you look at the overall picture, right? Because if I was just looking at Starbucks, like I mentioned, I would think having a negative shareholder equity is bad. It still is bad, but to see that all the other competitors have similar values or similar trends, then it helps me understand that this is a typical behavior. And in my opinion, I'm most likely going to say it's based on real estate. All these companies need to have a lot of real estate, and there's probably a lot of mortgages and loans to buy these real estates that right now those loans outweigh the total assets that they provide. So yeah, that's based on the shareholder equity. But one good thing, Starbucks has the least amount of negative shareholder equity. So it's doing better than the rest. And then we can see the company's total debt. Yum and Starbucks are sitting pretty much with around $11 billion of total debt. McDonald's is triple their debt, and that's actually pretty crazy. That's McDonald's, but I'm guessing McDonald's is such a bigger company. But we can see McDonald's is sitting at 32. But again, we can see Starbucks and Yum having similar debt levels. So that again tells me there's nothing crazy going on here. So it definitely gives me reasons to proceed and keep looking at Starbucks. All right. So next we're going to take a look at the company's total revenue. So the company's total revenue in the past quarter continues to have an uptrend. That's good. The cost of revenue, obviously, if they're making more sales, this means more restaurants, this means more employees and more stuff. So cost of revenue is also going to go up. So we have the uptrend in cost of revenue. Gross profit, which is the money after cost of revenue is kept, is also at an uptrend. This uptrend means that revenue itself is growing at a faster rate, at a higher rate numerically wise than cost of revenue. And that's why we have this positive gross profit. One thing I don't like though is if we take a look at this company's net income, it seems to have been pretty flat, right? If we take a look here, this net income level, we can draw a straight line right here, and it seems to have been pretty much flat. But if we look at earnings per basic share, it does seem to have an uptrend going up and going up. And this to me tells me one thing. If net income is pretty much staying the same, but we're seeing an uptrend in earnings per basic share, this company has a nice shareholder buyback program. And it's buying back some shares that is reducing the amount of shares that is dividing its total net incomes with. So we can see this company does have some form of shareholder returns. So that's good news, right? But I definitely don't like to see that even though we're seeing revenue increasing, net income still remains flat. All right, so next we're going to take a look at this company's balance sheet. The first thing here I noticed is this huge jump of total liabilities in the past, in September of 2018. Definitely have to do some research to see why there was that liability jump there. But ever since then, liabilities started taking over total assets. And I definitely don't like to see a negative shareholder equity. But actually, I remember now. I did an episode of Starbucks a few years ago, a few months ago, and now I remember that this is based on deferred revenue. Yes, this is based on $8 billion of deferred revenue. So let me take off that $8 billion of deferred revenue. This would give a total liability of about 17 billion. All right, so now this is interesting. This company, we're going to talk about it later, but now I can see that in real life, I will consider that this company has a positive shareholder equity. And I want to see if the other companies, let's take a look, if the other companies have any form of deferred revenue. Is that something I can take a look at here? Deferred revenue. Yes, that's something we can take here. No, Starbucks is the only one with such a huge deferred revenue. So if we take off this deferred revenue from the company's total liability, then of 8 billion, that would mean shareholder equity of Starbucks is right now positive $2 billion. All right, so I'm gonna backtrack in a bit and let you guys know what I'm thinking about right now. But let me just continue with the flow. So right now, total assets is actually screw it. Let me go. So a few months ago, Starbucks made a plan to have where they sold. So deferred revenue. Let me first explain what deferred revenue. Deferred revenue is Starbucks has collected some form of revenue from some products that it has not delivered yet. So it hasn't delivered yet, but it's already collected the products. So what does that mean? That means that right now it goes in the liability sheet because what if Starbucks is unable to produce these products? It sold these products to Nestle in some form of long-term agreement plan. I forget how long the plan is, but it sold this product and they got paid for something up to 2020. So they have all this time where they need to provide products to Nestle. So until they provide all that products to Nestle, whatever the company is called, this is called this will be in the liability because right, if this company is unable to do it, this money has to go back. But in my mind, I don't think that would be the case. The probability of that happening is the case. So I'm gonna erase that from liabilities. So that's a whole $8 billion erased from total liabilities. And that would make this company actually positive shareholder equity. Right, so we take off, like you said, we take off 8 billion from this 25. That would make this a total liability of 17 billion based on total assets of 19 billion. Will give this company a positive shareholder of $2 billion. And then what I did was then I took a look at the other companies, at the other companies that all had. We know that Yum and McDonald's all had negative shareholder equity. And I wanted to see if this negative shareholder equity was due to the same reason that Starbucks does, that Starbucks has that huge liability. And no, that's not the case. So that to me is giving me really good news. It's actually showing me that, hey, Starbucks is actually doing better than these other two companies. And that's why I'm so pumped right now. This is happening live, guys. This is what goes on my mind when I look at stuff like this. And that's why I enjoy looking at these videos, because now doing this video, I was able to figure this out. So now I'm going to definitely 100% take a look at Starbucks, but it's looking really, really good for Starbucks. So let's break down their total asset distribution and liability distribution, right? This company has $11 billion of non-current debt. That's not a bad amount in my opinion compared to in the 10Q report. I'm gonna have to take a look at how long this long-term debt is non-current debt is imposed for. Like are there some loans from up to 2040, and how long does a payment does this company has? What are the interest rates? But in my opinion, these are going to be low interest rates because we're on a low interest rate market, and also I don't think the timeline is that close to each other. If not, things will look a lot scarier. This company has no current debt. It has tax liabilities and payables, which is current liabilities of about 2 point something billion dollars. Again, these values seem to be the same throughout its time. So again, especially in payables seems to be the same. So if it was able to pay this 5 years ago, it's going to be able to pay it now when it's doing better. The only thing is this tax liability is a lot higher this quarter compared to March quarter. So we might see a huge hit in cash and cash equivalents within the next few quarters. So now we're going to take a look at asset distribution. Obviously, a huge portion of this company's total assets are real estate, property, plants, and equipment. I'm pretty sure this company has its own brewing factory where they make their beans and all this and all that. So it's no surprise that this company has a huge amount of property, plant, and equipment assets. Next, we're going to see is this company has about 70 million in current investments, 600 million in non-current investments, 2.7 billion in cash and cash equivalents, and 879 million in receivables. So if we add receivables and cash equivalents, that would give us somewhere around $3.4 billion, $3.5 billion. And if we take a look at just the current liabilities, which is payables and tax liability, which is $2.9 billion, $2.3 billion, that $3.5 billion of assets is a lot higher than those $2.4 billion of liabilities. So that to me tells me that this company, right, it's in a safe place. I don't have to worry about it not being able to pay its debt. Then what can we see here? This big one that swings, and that's cash and cash equivalents. Everything else looks pretty okay. It has about $1.53 billion in inventory. But if we take a look at the chart that I'm looking, that seems to maintain the normal range it normally has. Same with its receivables and its tax. Its tax assets has increased. So hopefully that tax assets will help pay off the tax liability. And we actually might not have to see any downtrend in cash and cash equivalents. So now I'm pumped that I saw that deferred revenue. That deferred revenue, in my opinion, is fake liabilities. It's 100% fake liabilities, in my opinion. All right, so now let's take a look at the company's net cash flow. This company has a positive net cash flow from operations, but it doesn't seem to be increasing over the quarters, right? It's within range of what it normally is, and it's sitting at $1.1 billion. And to me, net cash flow from operations is the only cash flow I care about, because it means that this company is making money from its everyday use. But actually, we can here see that this company is actually buying back shares in this past quarter. It actually bought back $2.2 billion of shareholders, and it has been buying back shares in the past few quarters. So that's why we see that earnings per share increase even though net income remains flat. And we also see, right, that net cash flow from operations is pretty much flat. So that to me, again, I definitely would like to see an increase in that. But I guess I have to understand how the business really works to understand why, even though revenue is increasing, the total net income and net cash flow is pretty much flat. This company is also paying off a nice dividend of about $430 million per share per quarter. And obviously, if they're buying back shares, then that dividend is going to be reduced by less share. It's going to be increased because there's less shares around to pay dividend. And this is how this company is giving back to its shareholders. So it definitely has a strong shareholder program. Next, I want to take a look at net cash flow from operations and revenue. And this is what I was just talking about, right? In theory, when I see revenue going up, I should see net cash flow from operation going up in the same trend. And that's not what's going on here. And I'm not a fan of that. So this is something, when I do a research on the company, I'll have to understand why this is happening. Next, what we're going to take a look at is earnings per basic share and compare the cash flow from operations. Again, earnings per basic share and cash flow from operations should actually be pretty close to how they move. And yes, this is what we see here. They're actually pretty much intact to how they move, outside from any crazy outliers going on. Finally, the last thing we're going to take a look at is some ratios based metrics just on Starbucks alone. We already saw price to earnings ratio, debt to equity ratio. We don't really want to see because this company has a negative in quote shareholder equity. When in reality, I don't believe it does. So this debt to equity ratio will be different. Free cash flow. This company has a positive cash flow of 582 million after everything has been done from its operations. So we can see that is normally within the range. We can see this company's gross margin is pretty much very similar throughout its years, at sitting at high 50s. And same with its profit margins. Profit margins seem to be above 10 most of the time. Right now sitting at 11.9, and that's what seems to go within the average. So I'm actually liking Starbucks. My main reasons for liking Starbucks are these. First, we're going to see this price to sales ratio. This price to sales ratio tells me that Starbucks is a little undervalued when we compare it to its competitors. The next thing I like to see, is even though the PE ratio is high, it's still between its range where it normally goes. So we're going to have to take a look at future estimates and see where that's actually going to lead to. Next, I definitely like how this company has such a huge deferred revenue that in reality, it makes this company have a positive shareholder equity, which is better than every other company, every other competitor we took a look at. Things I don't like though are revenue is at an uptrend, but net income is pretty flat. Even though revenue has increased, we don't see a much increase in net income. The great thing is this company does have, and what seems to have, a very decent shareholder returns by buying back shares. And by buying back shares, they are increasing earnings per basic share, and they're also increasing the amount of dividends given out per share because they're reducing the amount of shares. We talked about the balance sheet. This company has a positive net cash flow from operations, so that's a good thing. Like I said, the same thing with net cash flow from operations and net income. They do not follow revenue, right? You definitely want to see that trend going on, and it's a bummer that that's not the case. And finally, right, profit margins and gross margins seem to be pretty much on par to what it's normally at. So this company is not, there's nothing funny going on with Starbucks right now. There's nothing too crazy going on. So this company is pretty much a very predictable on how it's going to behave. So I hope you guys enjoyed the episode. Let me know what you think. You guys saw my thinking in action. You see how passionate I am about this stuff. I enjoy looking at these numbers. There's so much happening in my head when I do this. So I hope you guys enjoy. Let me know what you guys think. Take care, have a good day, and see you next time when we actually take a look at Starbucks based on the actual information and based on what it's going to do in the future. And I'm pretty sure I'm going to end up buying some shares of Starbucks. Like I mentioned, I mentioned in previous episodes, I have just opened up a new account, and I'm doing it based on stuff I do on this show. So then we can see how my thought process is actually leading in future value. So take care, guys. Have a good night, and see you next time.